There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone. Today I want to talk about what causes a bull market, because a lot of people think that news or something like that can cause a bull market to begin. There are a lot of different factors that cause a bull market, and you can begin to see when a bull is beginning. There are certain factors that are there as well. And these are very important to learn because you can't really time the market, but you can anticipate the shift of trends and the changes of what's going on, and you can see these patterns develop and be ready and be prepared. If you're a long-term investor, you probably do not want to lose 50 to 80% of your capital base and your return on investments, the unrealized money that you've made on your stocks if you've had it for a long time, your 401k, your IRA, or just your long-term portfolio. But you also want to hold during a bull market for as long as possible. There are catalysts that actually create the momentum that drives the bull and the bear, and they're completely different than you think. Today we're going to explore some of those things that cause a bull market, and then next week we'll talk about what creates a bear market condition. Bull markets just don't happen spontaneously. They don't happen after the economy is robust. By the time the economy is prosperous and robust and expanding and everybody has a job, the bull market is in the final phases of its bull cycle. Everything goes up and down. Everything has cycles. There is nothing that goes up indefinitely, especially in the stock market. A stock will not go up and up and up year after year after year. There are business cycles, and these are expansion and contraction phases for the business as it grows. And these happen over time, and for each individual business, there's a specific type of cycle. There's a length of the cycle. For industries, there's a typical cycle. Some industries cycle annually because they're a cyclical industry. Others cycle every 5 to 10 years. Some cycle longer. Each company has its own business cycle. Each industry has its own industry cycle. And if you want to be truly successful investing long term, or with your 401k, or your IRA, or your own personal portfolio, or if you want to trade, I'm not talking about day trading, I'm talking about position trading or swing trading, holding a stock for several weeks to several months, or holding a stock for several days to a few weeks, you will have to understand cycles. The primary catalyst for a bull requires two elements to start the bull and sustain the bull. The first is an influx of money into the stock market. There needs to be money flowing into the stock market that hasn't been there before. That increases the demand side for stocks. As stocks are starting to be bought, liquidity drops, so the supply drops, so demand goes up. Stock prices rise, and you have the beginnings of a bull market. But without the second catalyst, that bull market will be rather slow and insipid. The second most important thing for a bull market that lasts for 10 to 15 years is new technology. One new technology is first an idea. It's an innovative way to approach a problem. It then goes into research and development, and then into the first prototypes of that product or service. We had cloud technology started somewhere between 2009 and 2010. In 2011, I started writing about cloud technology because it was obvious it was going to grow exponentially, and it did. Even Google and Amazon and other companies who were very big in it in the early days did not believe it would go from market introduction to market acceptance to mass market consumer acceptance so rapidly. The reason it did was because of the iPhone. The iPhone revolutionized how people used their phones. Instead of just being a cell phone to call people on or text people, suddenly it was access to the internet, access to your bank, photographs of your family, being able to send it through social media, all kinds of things. The iPhone, the way it was created, totally revolutionized how we communicate and our social structure. And that's a displacement, disrupted technology. It displaced the old cell phone. It disrupted the social order, how we communicate, how we interrelate. It took advantage of social media. It took advantage of the internet. It took advantage of all kinds of opportunities to totally change how people live. And a lot of you have lived through this change. But it's only the beginning. There are far more new technologies coming to market right now that are going to be integrated quickly into the mainstream consumer products that you use every day. And these are going to totally and completely revolutionize again our society and how we work, how we play, how we get information, how we educate our children, how we do everything. And that's an important thing because we have to have both an influx of money and then an influx of new money into the stock market, and we have to have new technologies. It requires both for a long-term great bull market. A great bull market lasts anywhere from 10 to 18 years. It can last a long time. There was a bull market between 1982 and 2000. Lasted that long. Yes, there were corrections, but there was no major bear at all that lasted a year to a year and a half, as they normally do, during that time. There were very brief corrections, but nothing really long and nothing really deep. So we could have another long bull market if we have those two factors, new technology that's displacement and disruptive, and an influx of new money to drive the stock market up and to create the demand for more and more IPOs, for more companies, and for more stock, more mutual funds, more pension funds. All of this has to be driven by an influx of new money into the stock market and new technologies that are both displacement and disruptive. We have the displacement and disruptive technologies at hand. The innovators and inventors of this next generation are already busy creating new products and services that will totally change how we live in every aspect. From our personal lives to our professional lives, everything will change. And it's happening very rapidly. The question is, are we going to have influx of new money into the stock market to fuel the demand for this new technology? And usually it does happen. So those are two factors that people forget. They like to think that the stock market just grows because the economy is doing well, so therefore stocks must do well. No. Business starts the cycle. When a brand new technology and a little startup come to market and consumers find it intriguing and the early adopters buy it first and then it changes and goes through some changes and then the secondary adopters will buy it and the manufacturers will again make some changes and then the mass market will take hold. And you'll have several years of people buying this product that's brand new and it'll be going through some changes. But essentially, it is the same product. Everywhere you go, people are on their phones. Everywhere you go, someone is doing something with their phone. If it's a shopping list or if it's music, whatever, the smartphone has become the number one consumer product. But there are more things coming. And it will change and evolve even further. There'll be more and more things that can be done to the phone over time. These things evolve. Think about it. In the 40s, the first computers were built for World War II. And they were behemoth things that took up an entire building. And each generation of computer got smaller and smarter and smaller and more efficient and smarter, holding more data, doing more work. Until all of a sudden we had the PC computers, which were home computers in their first days, and now they're small desk computers that people use. People will always have to use a desk computer for some work, but they use their phones for a lot of the internet searches and things like that. With the iPhone, mobile devices became very popular. With the iPhone, social media went viral. With the iPhone, the ability to take pictures and videos exploded, and so there's more and more YouTube and all of that. This one element spiraled out and created far more product and services and opportunities than ever before. So you can credit just that one single product to creating a whole growth factor in the new technologies for consumers and businesses relating to the smartphone. The new technology that's coming to market is far more invasive and far more extensive. It's not just a phone. It's biotechnology and nanotechnology. It's solar and all kinds of different new revolutionary things. One new technology makes it possible for another new technology to leapfrog forward, to be better, to be smaller, faster, whatever is needed. A bull market can last anywhere from 5 years to 15 years or longer. A bear market can only last a year and a half to 2 years. The longest bear market in recorded history is only 2.8 years, and that was the 1929 crash. That then was followed by the Great Depression. The stock market crashed and the Great Depression occurred, not the other way around. The stock market leads the economy. In 2007, the stock market started to peel away, and in 2008 there was a stock market crash. Not because the stocks were oversold or that there was no new technology, but the real estate bubble infiltrated the stock market, and the banks were such a big part of the stock market that when the banks nearly collapsed, it caused the entire stock market to collapse. Many companies went down in value that had no reason to go down in value other than that there was panic on Wall Street. That only lasted from 2008 to March 2009. Not very long when you look at it from that perspective. In March 2009, the stock market bottomed and it started to recover. Now, that wasn't the end of the recession. The economy remained in a recession for several more years, but the stock market rose during that time. A stock market needs from time to time to correct. A lot of times speculation will enter a market and the bull market will become over-speculated. In other words, the value of the company on which the stock is based, its fundamentals have fallen behind the stock price. The stock exceeds the price value of the underlying company. And when this happens, it's called over-speculation. And it happens from time to time. Pretty common thing to have happen. People get all excited. They all want to buy the stock. They're not thinking about whether the fundamentals are in line or not. They buy it, shoot the price up. Then those who are very wise and who got into the stock very early, and so there's a correction. The stock market can correct two ways. It can have a bear market or it can have a trading range market. Trading range markets go sideways rather than down. And this creates a strong support level and a continuation pattern. A bear market has to end and then resume the uptrend after that. So bull markets have a lot to them. And a lot of people think, oh, one big down day, oh, the world is coming to an end. But it's common for the stock market to go up, and then down a little, up, and then down a little. Just like bull markets last a very long time in relation to bear markets, the daily trend is always upward, and there's always going to be a short-term correction or a retracement. But it's not going to last very long. It's all dependent on the angle of ascent of that trend. And if it gets too far away, then those who know what they're doing will start selling stocks against those buyers, and when the buyers evaporate, then the stock starts to correct. It's all very specific. So in a bull market, in the beginnings of a bull market, it won't feel like a bull market. Sentiment's going to be very negative. There's going to be high unemployment and more layoffs. Companies are in a contraction phase. They're tightening their belt and they're getting ready to reinvent. So in the beginning years of a bull market, it does not feel like it. It doesn't seem like it. And that's why most investors miss out on the best growth years of the bull market. Because they wait until the economy is robust and growing and unemployment is very low and there's lots and lots of jobs around. They think, okay, now that I'm going to buy stocks because it's okay to buy stocks. Wrong. Because the bull market is then at risk of a correction or a trading range because it has been going up for many years. Today we learned that the primary catalyst for a bull requires two elements to start the bull: an influx of new money, new investors, people who want to invest in stocks, And it has to have new technology coming to market, a market introduction to market acceptance phase, and it has to be a displacement or disruptive or both technology in order for it to actually change the environment and cause for a stimulus to create a bull market. Every time there is a new bull market, there is a new technology that starts and there's an influx of new money. Those are the two components that are required to start a bull. To sustain it, we need to have continued new technology, and we need to have more and more investors buying stocks. That's what sustains a bull market. The economy is just an afterthought. The economy is a reaction to the business cycles and the stock market. So as the businesses grow, the stock market goes up, and eventually the economy becomes strong and robust and grows and starts hiring more people. So there's a sequence, there's a cycle that occurs, and it starts with businesses. Businesses have to contract, lay off, and reinvent because they've gotten really big and cumbersome during the last bull market. So when they're nice and lean and mean and they have a new product, that's when the bull market starts. When they become really big and they have hundreds and thousands of employees and money is going out the door all the time and expenses are rising and payroll costs are rising and all of these different factors, the company now is not as efficient as it was when it was laying people off and cutting divisions and cutting back. So as a bull cycle grows, companies get sloppy with what they're doing and their new technology ages and fewer people are buying it. So now they're producing, and now they have too much inventory because people don't want to buy it because everybody who wanted to buy it has already bought it. Only about 80 to 85% of the population will ever buy a new technology product. The others will maybe buy at the very, very end, or they will not buy it ever at all. I still know people who still use the flip cell phones because they don't like smartphones. So there's a limit. So as the iPhone ages, they can enhance. But at some point, there's going to be a contraction. Next week, we're going to be studying the bear markets, and we're going to be understanding what causes a bear market so you can be prepared for when a bear market happens. If you understand what starts a bull market and what triggers a bull market after the bear market is over, you'll be able to get into stocks and make far more money than if you wait for the economy to be robust or waiting for recommended stocks. Investors need to be proactive. They need to learn how to find a great little company that's just on the verge of having huge exponential growth because they have a brand new product. The year for Apple to be purchased was 2003. Apple was around $19. I wrote about it to my students because I saw the opportunities, and it grew exponentially after that. So you want to get into stocks early, and most of you are buying stocks very late, after they've already been going up and up and up for 5 or 6 years. That is too late because most business cycles peak around 5 to 8 years. So if you're buying in late and then you don't want to give up, you're going to find your stock crashing and burning, and then you're going to be at a loss of 50 to 80% from your capital investment. So understanding how a bull cycle works helps you get in sooner, hold longer, and make more money for your 401k, your long-term portfolio, your IRA, or whatever long-term investment that you have. I'm Martha Stokes, and that's the radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.